Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two big tech stocks ahead of their upcoming earnings results, and that is Nvidia and Etsy. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so before we jump into Nvidia and Etsy, I quickly just want to take a broader look at the market as we always do in the show. So last week we saw the S&P 500 and the NASDAQ slip during the week, which is the week of February 15th. And this came after they closed at new records to end the week before that. And then we saw both of those indexes slip on Monday morning as well as U.S. Treasuries continued to climb. So we've seen some big drops in some big tech names. We've seen Apple and Facebook and Microsoft all continue to fall last week. And we saw some bigger or more pandemic style names like Zoom Video and Peloton also fall last week and then on Monday morning as well. With that said, the market fundamentals remain relatively strong, and we know that the ebbs and flows as well as pullbacks and corrections are certainly a healthy aspect of the market, and they need not be viewed as really anything but normal occurrences, especially as the earnings results continue to come in really strong for the fourth quarter. And better yet, the outlooks for the first quarter and the rest of 2021 have continued to improve significantly. We also know that despite some of the hiccups on the vaccine distribution front, hopefully this will help the economy start to roar back by the summer and start to help lift those hardest hit areas of the economy, such as that travel and leisure business that I know so many people are hoping return to something closer to normal later this year. And then meanwhile, Wall Street is certainly banking on more spending under the Biden administration, and the Fed remains firmly committed to trying to keep its interest rates as low as possible, despite some of the rises in the U.S. Treasury at the moment. So now we're going to take a look at the first of the two tech stocks that are reporting later this week, and that is Nvidia. It trades under the ticker NVDA, and the company is set to release its fourth quarter and fiscal year 2021 results for the period that ended on January 31st, this week on February 24th, so that is Wednesday after the market closes. Wall Street has known for years that Nvidia was ready to grow within the booming gaming industry. The video game industry is going to be a growth industry for years and years to come. The company also more recently had gained traction in that cryptocurrency mining world, and it certainly looks like it's ready to be able to do that going forward as well. But one of the bigger things that Wall Street has been paying attention to more recently is their ability to grow within the data center and cloud computing space. So the firm posted blowout Q3 results back in November with its data center sales up 162%. This helped lift its overall revenue by 57%. The company is also making inroads in artificial intelligence and other next generation technology as well. And we have to mention that the company back in September announced that it planned to buy ARM Limited from SoftBank for about $40 billion. For those of you who might have missed out on that big news, ARM is one of the most important behind-the-scenes companies in the semiconductor world, and it could certainly be a potential game changer for Nvidia and the industry. That said, the ARM deal has to get through regulators in the US, China, and the UK, and there are some recent reports that I've been reading, or not necessarily reports, but stories that are suggesting this deal might be not going through. As I said, it's going to be really hard. It's a really massive deal. It would certainly shake up the entire industry, and it has to get through regulators in 3 different countries. So it might not get through. That said, the company's outlook looks strong no matter what. So the company is still a GPU giant, and the stock's up 120% in the last year. That said, it has cooled off in the last 3 months, up about 13% versus industry's 23% climb. And it sits somewhat near its recent highs at the moment. It's trading at about $600 per share the last time I looked on Monday morning. So with this in mind, the company's valuation is certainly pretty stretched at the moment. That said, it's not overbought in terms of the relative strength index. It's resting at about 58, with anything above 70 considered to be that overbought range, and then any figure below 30 to be oversold. So it's got a little bit more room to run on that side. And looking ahead to what we expect for its Q4 and 2021 results, we're calling for about 55% growth in the top line in the fourth quarter and 48% growth in the bottom line to get all the way to $2.80 per share. With that said, the company is then expected to pull in 51% growth this year for fiscal 2021, and then about 68% growth on the bottom line. And this is coming after some down quarters for the always cyclical semiconductor business, but its Q1 results for 2022 are expected to jump 46% on the top line and another 41% on the bottom line to help it grow about 20% in 2022 on the top line and another 20% on the bottom line as well. So some solid growth both this year and next. With that said, this would help it return to growth after it slipped about 7% in 2020. And then it would compare really well to the 20% growth of 2019 and the 40% growth of 2018 before that. So some strong growth both this year and then expected next year as well. That said, the company's broader earnings picture has remained relatively unchanged over the last 30 days. So nothing moving there much in terms of earnings estimates. That said, the company has beat our bottom line estimates by an average of about 12% over the last 4 quarters. And at the moment, 16 of the 20 brokerage recommendations Zacks has come in at a strong buy, with 2 more at a buy and none below a hold. So we should note that the company or the stock fell Monday morning. This is amid a broader tech pullback, and there could be some more near-term selling as stocks have hit records as recently as mid-February. So despite all of the bullish outlook and the stronger than expected results so far from the Q4 earnings season, there could be some near-term selling pressure. So it might be best to maybe wait out to see what Nvidia's actual results and guidance come in like, as I said, amid some little bit of a volatility at the moment, even though we hit records not that long ago. And now we're going to take a look at Etsy, which operates a totally different business, but it's also been a big growth stock over the last year. That trades under the ticker that is exactly its name, which is ETSY. You can kind of consider it as an arts and craft fair style e-commerce firm. It has blown out Shopify, Zoom Video, and many other pandemic stars. In fact, it's about neck and neck with Tesla over the last year. The firm has ripped off back-to-back quarters of about 130% revenue growth as consumers turn to digital channels and entrepreneurs and small businesses also rush to get their sales online. So with that said, the company is set to report its Q4 results on February 25th. And we're going to see if people are continuing to shop at this rapid pace online. So that's Thursday, February 25th, or if things are going to cool off as people maybe return to something closer to their normal lives later in the year. So we're going to quickly break down Etsy, give you sort of their basic pitch. The company is an e-commerce marketplace that allows, as I mentioned, individuals, entrepreneurs, small businesses, and anything else really in between to sell everything from clothing and jewelry to art and home decor. The online retailer was founded back in 2005 and went public in 2015. It also owns a musical instrument marketplace, and its two-sided online marketplace has become really popular during the pandemic. And it's carved out a really solid space within the broader booming e-commerce industry by selling items that consumers might not be able to find on Amazon or eBay. More homey style products or specific things, as I mentioned. It's sort of the basic premise I can come up with. It's kind of an arts and crafts fair e-commerce marketplace. The company makes money from transactions as well as advertising and paid searches on their websites. The company is also continuing to try to improve its features for both buyers and sellers. So let's quickly look at what they did last quarter. So last quarter, Etsy's active sellers grew by 42% to about 3.7 million, while its active buyers jumped 55% to 70 million. Meanwhile, its gross merchandise sales soared about 120% to about 2.6 billion, with its overall Q3 revenue up about 130%, which fell just short of Q2's 137% revenue growth. So big growth in both Q2 and Q3. It is worth noting that the company has made a large chunk of money from face mask sales as people continue around the US and other places to wear face masks when in public and in stores and restaurants and all that. So that obviously has helped them during the pandemic, and hopefully for most people, those sales will slow. And obviously, no matter what, it doesn't seem that sustainable long term, as you don't need to keep buying new masks all the time. With that said, the company's gross merchandise sales, not including face masks, so excluding masks, still climbed 93% in the third quarter, so still up nearly 100% without face masks. And Wall Street has clearly known that face masks was a big part of this business, and they have not cared. The stock has skyrocketed over 300% in the last year and over around 55% in the last 3 months. To put it pretty close to its early February records at the moment. That said, in the stock, it's certainly not just a coronavirus play. It's been on a massive run. So the company's up about 970% in the last 3 years. This outpaces Shopify, and its growth over the last 5 years is even more impressive. So it's not just been a play since those March lows of last year. It's been on a really impressive run for a long time. With that said, the company is trading at its highest forward sales multiple at the moment, yet at about 15 times forward 12-month sales. It represents a big discount to another hot e-commerce name in Shopify, which is trading at about 43 times forward sales. So Etsy's trading at 15, Shopify is trading at 43 in terms of these huge growth e-commerce plays that have been on a big run during this pandemic period. The company was also, as we mentioned, growing long before the pandemic in terms of the stock price, and it had that top line growth to help support that. So its 2019 and 2018 sales both climbed by roughly 36%. So with this in mind, we're calling for another big quarter. We're calling for its adjusted Q4 earnings to surge about 140% on 91% stronger revenue. So a slowdown from what they've done the last two periods, but still 91% growth we're calling for in the fourth quarter. So overall, Etsy's fiscal 2020 revenue is projected to jump about 100% to about 1.63 billion, with its adjusted earnings expected to climb 182%. So overall, the company's earnings revisions see it land about at a Zacks rank number 3 hold right now. With that said, the company has also topped their earnings and revenue estimates in the last 2 quarters. And even though the pandemic conditions clearly will be nearly impossible to recreate, the e-commerce market is still in its very early days. So e-commerce accounted for only 14% of total U.S. retail sales in the third quarter. This was up from 11% in the third quarter of 2019, but down from a record of about 16% in the second quarter. So still, despite all of the talk and all of the e-commerce growth, it is still in its early days accounting for only 14% of total U.S. retail sales. So it has miles to grow, which would help Etsy and all of these other e-commerce players. With that said, a slowdown certainly appears to be coming. Its 2021 revenue is projected to jump just 10% above that hard to compare year in 2020, with its earnings per share figure also projected to slip about 10%. So maybe it's time to wait for Etsy's management to provide updated guidance. Maybe they're expecting better results next year. It's been a red hot stock, and there could certainly, as we mentioned, with all of these stocks at the moment, there's near-term selling pressure. The stock was down about 4% on Monday morning, sits about 10% off its records. This has put its RSI to about 52. So it's sitting at 52 on the relative strength index, down from nearly that overbought range of about 70 in early February. So the stock has sold off recently, sitting about 10% off its highs heading into its earnings release on Thursday. As I mentioned, it's a little risky if you're looking for a near-term play, but maybe at 10% off its recent highs, it's worth if you're a longer-term investor. But as I said, this week looks like it could maybe be a little chaotic. So even though 12 of the 15 brokerage recommendations that Zacks has come in at a strong buy for Etsy at the moment, it is expected to slow down significantly in 2021. So it's probably best to wait to see how Wall Street reacts to its results and what management provides in terms of guidance for this upcoming year. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.